So by now, you guys would have got a lot of command over budgetary concepts. Now let me come to the analytical part. And here I am discussing the importance of tax revenue receipts and high capital expenditure. In the previous one, I told you how a high tax collection was helping us fund our capital expenditure. Let me show it again. So let's plot it like we have different things. Let's not plot it. Let's put it like revenue expenditure, capital expenditure, revenue receipts, capital receipts. If revenue expenditure is more than revenue receipts, it is called revenue deficit. If we have revenue deficit, means this account, this complete revenue account, if it is in deficit, then from capital receipts, some part of the debt creating receipts would be used to finance this revenue deficit. Right? Point is, we hardly have any non-debt creating capital receipts. We have seen it. Out of 16.9 lakh crore rupees capital receipts, the non-debt creating is just 0.8. Majority of it is like debt creating. So if this account goes in deficit, then this deficit is going to filled up with debt creating capital receipts. That means lesser fund would be available for capital expenditure. Lesser fund available for capital expenditure means lesser road creation, road construction, airport, port, power plant. If less number of infrastructure, if less amount of infra is created, it means less amount of tax collection. If companies are constructed, if roads are there, airports are there, power plants are there, then only companies would be set up. Companies are set up, companies would produce things. So when they produce things, GST would be collected. When companies are going to produce things, they are going to employ people. When they employ people, income tax will be collected. Top of that, companies produce something, they're going to earn money. On that earning, they'll have to pay corporate tax. So if we have capital expenditure, then the revenue receipts would increase. Now, let's see another case. The revenue expenditure is less than revenue receipts, that is, revenue receipts are more than revenue expenditure. If this happens, this is called revenue surplus. If we have revenue surplus, then this account is in surplus. Then we have complete capital receipts, debt creating, non-debt creating capital receipts. This surplus of revenue account plus complete capital receipts, these three components would be used to finance capital expenditure. And then this high capital expenditure would lead to high revenue receipts, and this high revenue receipts would further lead to revenue surplus. This further revenue surplus would be used to finance capital expenditure. So revenue receipts and capital receipts, they get into a virtuous cycle. If revenue account is in deficit, it means we'll have less funds to spend on capital expenditure. And if revenue account is in surplus, it means the surplus of revenue account plus the complete capital receipts would be used to finance capital expenditure, and the economy goes into a virtuous cycle. So the focus of the government has to be on getting high capital expenditure and getting more of revenue receipts. We have discussed earlier 80% of India's revenue receipts are coming from tax revenue receipts. The focus of the government has to be on increasing revenue receipts. That can only happen if tax revenue receipts increase, and tax revenue receipts can increase through increase in tax rate or by increase in tax base. We have seen through Laffer curve that the tax collection cannot keep on increasing because of increase in tax rate. People would stop paying taxes at a particular stage. The only focus for the government has to be on increasing tax base. Increase in tax base will come through tax reforms like GST. So bring GST, bring tax reform increases tax base increases tax revenue receipts, which increases revenue receipts, which help us finance more capital expenditure, which help the economy get into a virtuous cycle. I hope things are clear.